They told you the age of easy money was over. They told you the golden era of Monters Stocks had ended, buried beneath the wreckage of tech bubbles, pandemics, rate hikes, wars, inflation shocks, and market crashes that arrived with relentless precision. They told you regulators had learned their lesson that capital would never again allow a handful of companies to dominate entire systems the way oil giants ruled the 20th century. And for a moment, it felt convincing. Because chaos has a way of making patterns invisible, but history does not end, it compresses. Between 2020 and 2025, while headlines screamed crisis, global equity markets quietly added over $25 trillion in total market capitalization, and more than 70% of those gains flowed into fewer than 30 companies. This was not diversification. This was concentration. The same concentration that defined railroads, oil, software, and the internet. Only this time, it was happening faster, quieter, and with more complexity. Because when systems change, wealth does not disappear. It migrates. And it migrates toward control points. This is not a story about stock tips or quarterly trades. This is a story about power, about who owns the infrastructure when civilizations upgrade, about who controls behavior when attention becomes scarce, about who gets paid when entire economic layers are rebuilt from the ground up. Because markets don't reward effort, they reward position. Every major wealth cycle in history has followed the same blueprint. In the early 1900s, steel and railroads controlled physical movement. In the mid-1900s, oil and automobiles controlled energy and mobility. In the late 20th century, software and personal computing controlled information. In the early 21st century, the internet and smartphones controlled attention. Each era created monster companies, not because they were exciting, but because they were unavoidable. Today, we are witnessing the birth of another unavoidable layer. Artificial intelligence is not a product. It is not a feature. It is not an app. It is a computational force multiplier being embedded into everything. Medicine, defense, finance, logistics, entertainment, transportation, scientific discovery, and governance itself. At the same time, consumer behavior is being reshaped by speed, habit loops, personalization, and emotional branding in an economy where time and attention are the rarest commodities. These two forces, AI infrastructure and habit-based consumption, are where the next 5 years of wealth creation are being engineered. And at the center of the first force sits a company most people think they already understand. They think Nvidia is a chip company. It is not. Nvidia is a gatekeeper. For decades, computation followed a predictable path. Central processing units handled most tasks, improving incrementally year after year. But as data volumes exploded and models became exponentially more complex, CPUs reached their physical and architectural limits. Training modern AI models requires performing trillions of calculations simultaneously, a task CPUs were never designed to handle efficiently. Graphics processing units were. Originally built to render video game graphics, GPUs excel at parallel computation. They can process thousands of mathematical operations at the same time, making them ideal for machine learning workloads. But hardware alone does not create dominance. Software does. Nearly 20 years ago, when artificial intelligence was still a niche research field, Nvidia made a decision that would later define the entire industry. It created CUDA, a software platform that allowed developers to program GPUs for general-purpose computing. And instead of monetizing it aggressively, Nvidia gave it away. It embedded it into universities. It trained researchers. It built muscle memory into an entire generation of engineers. This decision did not move the stock price at the time, but it rewired the future. Today, an estimated 80% to 90% of AI workloads worldwide run on Nvidia hardware. More than 90% of advanced AI research frameworks rely on CUDA-based workflows. Millions of developers are locked into an ecosystem not by contracts, but by efficiency. Switching away is not impossible. It is impractical. This is not brand loyalty. This is dependency. And dependency is the most durable form of economic power. As AI models grew larger, another bottleneck emerged: orchestration. Coordinating thousands of GPUs across massive data centers, managing memory, bandwidth, timing, and data flow. This invisible layer determines whether an AI system is profitable or unusable. Nvidia moved into this layer quietly, expanding into networking, interconnects, and orchestration software that allows GPUs to function as a single computational organism. Its high-speed interconnects allow clusters of GPUs to share memory and data with minimal latency, transforming isolated chips into unified AI engines. Combined with deep integration across cloud providers and enterprise systems, Nvidia is no longer selling components. It is selling capability at scale. Follow the money. Global AI infrastructure spending surpassed $300 billion in 2024. Forecasts project this figure to exceed $1 trillion annually by 2030, growing at a compound annual rate of over 30%. Historically, in every technology revolution, 60% to 70% of profits accrue to infrastructure providers, not applications. The builders of the backbone always get paid first. By the time most investors realized artificial intelligence was not a trend, but a permanent structural shift, the money had already started moving. Quietly at first, then all at once. Capital does not wait for consensus. It moves toward certainty. And by 2024, certainty had a name: Nvidia. In just 2 years, Nvidia's data center revenue exploded by more than 200% year over year, a growth rate almost unheard of for a company that had already crossed a market capitalization of $500 billion. By late 2025, Nvidia's market value had briefly exceeded $2 trillion, placing it in the same league as the most dominant corporations in modern history. But valuation alone does not explain what is happening. What matters is margin, cash flow, and reinvestment velocity. Nvidia's gross margins surged past 70%, meaning that for every dollar the company generated, more than 70 cents remained before operating costs. Historically, only companies with deep monopolistic advantages, oil majors at their peak, Microsoft in the 1990s, Apple in the iPhone supercycle, have sustained margins at this level. High margins are not just a sign of profitability. They are a signal of pricing power, and pricing power is a signal of control. The reason lies beneath the surface. Nvidia is not competing on price. It is competing on performance per watt, performance per dollar, and most critically, performance per unit of time. In artificial intelligence, time is everything. Training a model weeks faster than a competitor can mean market dominance. That is why cloud giants, governments, and enterprises are willing to pay premium prices for Nvidia's hardware and software stack. By 2025, Nvidia controlled an estimated 85% of the global AI accelerator market. Not a segment, not a niche. The core. Advanced competitors existed, but none could replicate the full stack integration Nvidia had quietly assembled. Hardware, software, networking, orchestration, and developer mindshare, all aligned. Now consider the money flows. In 2024 alone, the largest cloud providers committed tens of billions of dollars each to AI infrastructure upgrades. Governments followed. Defense budgets across the US, Europe, and Asia allocated billions toward AI-driven surveillance, autonomous systems, cyber defense, and intelligence analysis. Unlike consumer technology cycles, these budgets are not discretionary. Once governments commit, spending becomes multi-year and politically protected. This is the same dynamic that once locked in military contractors and aerospace giants for decades. Nvidia is now entering that category, not as a weapons manufacturer, but as a computational utility. By 2026, even conservative projections suggest Nvidia's annual revenue could stabilize well above $150 billion, with free cash flow expanding alongside margins. If earnings grow at a moderated but still powerful 25% annual rate, simple compounding does the rest. At that pace, earnings double roughly every 3 years. This is where price scenarios become less speculative and more mathematical. In a conservative 2026 outcome, one where AI spending slows and competition increases, Nvidia could still justify a valuation that supports prices between $200 and $250 per share, representing roughly 40% to 70% upside from many mid-cycle levels. In a base case scenario where AI infrastructure demand remains strong and Nvidia retains ecosystem dominance, prices between $300 and $400 become not aggressive but rational, a 100% to 150% move driven by earnings expansion rather than hype. And then there is the scenario markets rarely price correctly until it is too late. If artificial intelligence follows the same adoption curve as electricity, cloud computing, or the internet, becoming embedded into every enterprise process, Nvidia transforms from a supplier into a utility-like platform. In that scenario, prices above $500 per share over the next several years are not extreme. They are consistent with historical infrastructure monopolies. But this story is not about one company alone, because history does not create power in isolation. It creates symmetry. While Nvidia monetizes intelligence at the highest levels of technology, another company is quietly monetizing something far more ancient: routine. Every economic system ultimately depends on human behavior, and the most valuable businesses are not those that win one-time purchases, but those that embed themselves into daily life. This is where the second monster stock enters the frame. Dutch Bros operates in an industry where growth is notoriously difficult. Food and beverage chains typically fight for 2% to 4% annual growth, often losing pricing power during economic slowdowns. Yet Dutch Bros has consistently delivered 5% to 7% same-store sales growth, even during periods of inflation and consumer stress. That number matters. Same-store sales growth indicates not expansion, but loyalty. It means existing customers are visiting more often, spending more, or both. In recent quarters, Dutch Bros recorded transaction growth approaching 5%, signaling increased frequency rather than price-driven inflation. Frequency is habit. Habit is power. Dutch Bros currently operates fewer than 1,100 locations, yet market studies and internal projections suggest the U.S. alone can support 6,000 to 7,000 stores. That means less than 20% of the long-term opportunity has been realized. Each new location is small, efficient, and relatively inexpensive to build, often reaching cash flow break-even in under 24 months. This creates a compounding engine. Faster payback enables faster reinvestment. Faster reinvestment enables faster expansion. And faster expansion strengthens brand visibility, which feeds back into demand. But the most overlooked variable remains food. At established competitors, food accounts for 18% to 22% of total revenue. At Dutch Bros, it accounts for less than 2%. When pilot food programs were introduced, participating locations saw immediate revenue lifts of approximately 4% without significant marketing spend. If food penetration rises even to 10% of sales, revenue per store increases dramatically with minimal incremental cost. Now project this forward to 2026. In a conservative scenario, where consumer spending remains pressured and expansion slows, Dutch Bros could still trade between $45 and $55, reflecting steady growth and brand resilience. In a base case scenario, where store count approaches 2,000 locations and food monetization scales gradually, prices between $70 and $90 become justified. A 60% to 100% upside from mid-cycle levels. In a full execution scenario, where Dutch Bros captures Starbucks-like cultural relevance among younger consumers, prices exceeding $110 to $130 over the next 5 years are not unreasonable. Put these two trajectories together and the pattern becomes unmistakable. Nvidia compounds through infrastructure dominance and institutional demand. Dutch Bros compounds through habit, frequency, and geographic expansion. One monetizes computation, the other monetizes routine. One scales through silicon, the other scales through psychology. History has always rewarded companies that control systems rather than chase trends. The next 5 years will not belong to the loudest narratives, but to the deepest structures. And while markets argue about cycles, inflation, and volatility, the real story is unfolding quietly beneath the surface. The question is not whether these systems will grow. The question is, who will be positioned when they do? While Nvidia is engineering the future of intelligence, Dutch Bros is engineering the future of routine. First glance, a coffee chain may seem trivial next to a $500 billion AI infrastructure company. Yet every economic historian will tell you, empires are not built only on technology. They are built on behavior, on patterns, on rituals repeated millions of times each day. Coffee is one of the most habitual products in modern life. Unlike technology, which can be upgraded or replaced, habits form slowly and resist change. Studies show that 50% to 60% of daily consumer behavior is habitual, automatic, and emotionally reinforced. If a brand embeds itself into those habits, it achieves predictability that no quarterly earnings report can shake. Dutch Bros has done exactly that. With fewer than 100 stores nationwide, it has cultivated an emotional connection with customers far beyond what the numbers alone suggest. Same-store sales have grown 5% to 7% per year. Transaction volume is up 4.7%, and loyalty metrics indicate repeat visits far exceeding industry averages. Its customer base is not only growing, but becoming embedded into daily routines. The strategy is simple yet subtle. Speed, personalization, recognition, drive up, order, be acknowledged by name, leave with a smile. In a world where attention is scarce and choice is overwhelming, Dutch Bros simplifies the decision. It creates a dopamine loop, a ritual, a microtransaction of happiness. And as behavioral psychologists will attest, once a habit forms, resistance to switching brands is remarkably high. But habit alone does not make a monster stock. Scale and optionality do. Compare Dutch Bros to Starbucks in its early expansion. Starbucks didn't dominate global coffee overnight. It scaled methodically, testing markets, refining operations, standardizing experiences, and then replicating the model in new regions. Dutch Bros is at the same point in its life cycle, operating less than 20% of its long-term store potential, meaning the majority of the market opportunity is still available. Each new store contributes predictable cash flow, short payback periods, and incremental market share without heavy capital risk. Food represents the next inflection point. Starbucks generates roughly 20% of revenue from food. Dutch Bros generates less than 2%. Pilot programs introducing hot food have already lifted store revenues by approximately 4%. And this is before nationwide rollout. Once fully deployed and supported with marketing, food sales could increase total revenue per store by 15% to 20% without proportionate cost growth. This is optionality, latent value waiting to be unlocked. Institutional investors understand this pattern. Expansion stage consumer brands with high unit economics, strong customer loyalty, and replicable operations are rare. When they appear, capital flows quietly but decisively. Unlike speculative tech hype, these investors are in for the long haul, compounding returns over years, not months. Demographics also favor Dutch Brothers. Younger consumers increasingly prioritize speed, authenticity, personalization, and emotional connection over prestige or brand heritage. Dutch Bros' culture, marketing, and product strategy align perfectly with these preferences. By embedding itself into daily routines of younger generations, it creates generational loyalty that compounds over decades, the kind of predictability that turns small growth companies into market leaders. Projecting forward to 2026, the numbers speak volumes. In a conservative scenario, Dutch Bros could reach $45 to $55 per share, reflecting steady expansion and strong unit economics. In a base case scenario, as store count approaches 2,000 locations and food contribution increases, prices of $70 to $90 become plausible, representing 60% to 100% upside. In a full execution scenario, where brand awareness, culture, and habit formation hit a tipping point, prices exceeding $110 to $130 are entirely consistent with historical patterns of consumer domination. Compare this to historical giants. Starbucks, McDonald's, and Coca-Cola all followed the same sequence. Identify a daily habit, embed themselves into routines, expand with replicable units, and gradually monetize optionality. Dutch Bros is at the early innings of the same playbook. The stage is set. The machinery is in place. The audience, habitual consumers, is ready. When placed alongside Nvidia, the narrative becomes strikingly clear. Both companies dominate infrastructure, one in silicon and computation, the other in behavior and routine. Both leverage invisible control points. Nvidia's GPUs are the backbone of intelligence. Dutch Bros stores are the backbone of daily rituals. One scales with code and electricity, the other with psychology and service design. Both are positioned to compound for years, quietly, while the broader market debates cycles, volatility, and headline noise. History shows us that power often hides in plain sight. Railroads once looked like ordinary steel tracks. Oil pipelines once looked like mundane pipes. Software platforms once looked like code libraries. The companies that ultimately created empires were the ones controlling the flows of energy, information, or behavior. Nvidia controls the flow of AI computation. Dutch Brothers controls the flow of habitual consumer spending. And as the next 5 years unfold, both will benefit not from speculation, but from the structural certainty of their position. As 2026 approaches, the stage is set. The previous decade's market turbulence, rate hikes, pandemics, geopolitical conflicts, and tech bubbles was only the prelude. Now, two companies sit at the nexus of structural change, quietly capturing value in ways that history shows few others can replicate. Nvidia, the computational backbone of artificial intelligence, has positioned itself as an unavoidable infrastructure provider. Its dominance is reflected not in hype, but in tangible metrics. Over 85% market share in AI accelerators, gross margins exceeding 70%, and multi-billion-dollar contracts with cloud providers and governments. Its ecosystem, CUDA, networking, orchestration software, ensures that switching costs are monumental, locking in decades of advantage. By 2026, analysts project Nvidia's revenue could reach $180 billion, with earnings compounding at 25% per year. In practical terms, that translates to stock prices in the $300 to $400 range under base case assumptions, and even higher, $500 plus per share, if AI adoption accelerates beyond expectations. It is a scenario that mirrors historical monopolies. Microsoft's dominance in enterprise software, Amazon Web Services in cloud, Intel in CPUs during the 1990s and early 2000s. Nvidia is not a chipmaker. It is the foundation upon which the next technological empire will rise. On the consumer side, Dutch Bros represents a different but equally powerful form of dominance. While Nvidia captures intelligence, Dutch Bros captures habit. Same-store sales growth of 5 to 7%, transaction increases near 5%, and early food expansion tests delivering 4% lifts per store indicate a replicable and scalable engine. The company operates fewer than 1,100 stores today, but has the potential to reach 6,000, 7,000 in the US, leaving more than 80% of its market opportunity untouched. Projecting forward, Dutch Brothers could see conservative prices of $45 and $55 per share by 2026, base case estimates of $70, $90, and full execution scenarios exceeding $110 and $130, representing 60, 150% upside. The mathematics is simple. Embedding into daily human routines creates predictability, reduces volatility, and compounds revenue over time. Exactly the behavior that has fueled the rise of Starbucks, McDonald's, and Coca-Cola historically. Together, Nvidia and Dutch Bros illustrate a fundamental principle. The most enduring wealth is captured by controlling systems rather than chasing narratives. Nvidia controls AI infrastructure. Dutch Bros controls consumer behavior. Both leverage invisible control points, one technological, one psychological. Both scale predictably, efficiently, and in ways that are difficult for competitors to replicate. The implications extend beyond stock prices. These companies exemplify the structural forces reshaping economies. Acceleration of capital flows. Investors increasingly favor businesses with predictable compounding engines. Capital migrates quietly but decisively toward those who control infrastructure or habit. Reallocation of power. As AI becomes embedded in healthcare, finance, logistics, and governance, and as consumer habits consolidate around loyal brands, the winners become near irreplaceable. Historical parallels. Just as steel, oil, and software created the titans of previous eras, AI computation and consumer habits are creating the next class of enduring giants. Future documentaries will look back at this moment, not as a boom or bubble, but as a turning point. A moment when artificial intelligence moved from experimentation to necessity, when behavioral branding became as valuable as infrastructure, and when investors who understood patterns, position, and compounding quietly captured extraordinary wealth. Markets may appear volatile in the short term. Headlines will scream about recessions, interest rates, or geopolitical crises. Yet structural advantages do not vanish because the news cycle changes. Nvidia's GPUs will still power the largest AI models. Dutch Bros' drive-thru customers will still crave the ritual of morning coffee. The systems remain intact, and that is what drives compounding over 5, 10, and 15 years. By 2026, one could reasonably expect Nvidia to consolidate its dominance with multi-year contracts and strategic partnerships, reinforcing its moat, while Dutch Bros will continue its methodical expansion, capturing untapped markets and monetizing food optionality. The result is a rare dual-engine play, one stock growing on the back of global technological demand, the other on the back of predictable consumer behavior. And here is the cinematic truth. When markets shift, the loudest stories are rarely the most profitable. The quiet structural plays, controlling infrastructure, shaping habit, embedding into systems, are where enduring wealth is created. Nvidia and Dutch Bros are not speculative experiments. They are exemplars of this principle. As the camera pans back from the noise of daily headlines, one sees the invisible patterns emerge. AI computations humming inside massive data centers, and human routines humming outside coffee shops. Two different worlds, yet both governed by the same principle. Control the system, and you control the outcome. The next 5 years will test patience, insight, and conviction. Investors who focus on short-term volatility may miss the subtle, powerful currents shaping the markets. But those who understand infrastructure, habit, and compounding will see what others cannot. The wealth is not created in the obvious places, but in the foundational layers beneath the chaos. This is not the end of a story. It is the turning point of a new chapter. A chapter where artificial intelligence and human behavior converge to create the next generation of market leaders. And for those positioned correctly, it will be a chapter defined not by luck, but by understanding. Understanding how money, power, and human patterns truly move through history. Because history, as always, favors those who see the currents before the waves, subscribe for market insights.